Good afternoon, everybody. I'm Dan Hussey with Zaner Ag Hedge, bringing you a strategy of the day update here for July 6th, 2022. Remember, trading futures involves risk, is not suitable for all investors. And everything I talk about here today is just my own opinion and not a direct trade recommendation. I wanted to do a quick video for everybody to kind of break down the last 3 days worth of price action. We've certainly moved a lot since last week's Strategy of the Week update. There's a lot to talk about coming out of a shortened holiday weekend. And this is a good precursor to our Strategy of the Week report, which I'll be doing tomorrow at 2 p.m. Central. It's a live webinar. To sign up to become a part of that mailing list, just check the info section for this live, as well as the comment section below. I will be posting, of course, the links to sign up and be a part of that webinar every week. It's absolutely free, and I cover all the charts you see here and more, and whatever is hot and being bothered by the market this week. So let's begin today just with some of the outside markets that we've been talking about. We've been tracking and looking at. The bonds are in a pretty clear downtrend. This downtrend that we've seen, or really rate hiking environment that began. This is a daily chart back in 2020. Ever since then, we've been walking lower in the bonds and really higher in interest rates to some extent, right? And that's all capitulated down here with the last 7.75 basis point hike by the Federal Reserve back in early June or mid-June at that FOMC meeting. That then sparked a short covering rally and some risk off that occurred in the marketplace. But currently, we are still finding ourselves in a bit of a downtrend. We've come across trendline resistance here at the 142 handle. Yes, this is the first month of higher highs and higher lows that the bonds have made since the outside March candle, and arguably going back to December of last year, where we were trying to break out of trendline resistance and at that time the channel resistance that we had been forming. The market continued to break down, and since the last swing high, which was around the 166.23 area on the continuous contract, there was a 50% level drawn from that 166 high down to that low here in early February. We bounced up to 158, and then the market sold off down to its 146 target and through that target to the 140 area. That's the swing I'm using now from its low to new lows. You can see here maybe traded once, but definitely traded twice to target. That low to low, rallied up into the 142 handle, sold off down to our 130 low. Same anchor, new low of that extension had given us the resistance up in this 140 to 143 area. It's also where there's the trend lines. It's where this prior highs formed there in late April. And then, of course, the highs for, April, and then the highs for May. We've come back up to test that area. And today's kind of sweeping reversal pattern, when we get down to like the hourly chart or the 4-hour chart or some smaller time frame, we can start to track a little bit of a bond trend higher here, right? 50% off the lows held. They've gone to their targets. We would expect either the anchor from this highs to highs to potentially hold here, which arguably today we went through that 621.8 line. We're also breaking below this trend line support against the lows, and then we have another trend line support down here at 136, which means maybe the next in the series, 134 up to this high, the next support that we should be looking for on the chart of the bonds at this time would be at 138. But I don't know if I necessarily trust it too much. It's obviously proven itself once before. But if we do, end this series of higher highs and higher lows that we've been holding since June 28th, by breaking below 138, I do think we might be, heading back down towards that 130 low, and certainly just to the low end of the range. Now, ever since about June 13th, we started to unwind the inflation trade. In other words, that high correlated with the highs in the row crops that we've seen. It correlates with recent highs in crude oil. And it really just correlates with pretty much the risk-off mentality that we saw come to fruition in the stock market too. So once the bonds started to rally, there was a flight to quality. The US dollar started to rally over the same period. Stock markets got a little heavy. Row crops, other things that were leading the inflation trade or a part of that market price inflating started to go the other way. So that's something to kind of be aware of. If the bonds are rolling over, maybe the inflation trade is coming back. Crude oil, again, looking at a daily continuous chart here, the full 50% from the 62 lows to the 130 highs, 96.50 already traded support, and we came back down to retest that level here. Crude broke, arguably already was signaling, and the reason I'm starting to drop these triangle-like wedge is because we already broke 50% shorts off the highs and that push up towards 123.60. Broke above the 65 and the 61.8 threshold. And then on our way back down, we failed to hold the full 50% long at 108. It started to get a reaction there, then failed out. And actually, arguably the market then immediately after breaking that 61.8 line, traded up into a full 50% short from that 123 swing down to the 101.50 low here at 112.55. But now the market's traded down to its 96.30 target from that trade. So in the series that we have going lower for crude, 114.05 high down to the new low resistance, we're going to be looking for it around 104.57. We can get rid of this old 50% long, and we find ourselves potentially, if we give up that 107 area and we head higher, I don't know if we'll break through 120 right away, but we will be building up in what I would look at as an A, B, C, D up, and then potentially E down in some kind of triangle or wedge structure forming for crude. So that could see continuation higher, and maybe this period of deflation or unwinding the inflation trade has just moved oil and bounced it around sideways. Now, an important level I am watching to the downside here is a 50 or 100% extension. So this full swing lower from the 130 highs down to 97, 90 or 93, 92 lows, whatever. Extend that from our recent 123.60 high. That 86.10 area is very interesting to me. It's also where larger sloping trend lines would come up for crude, be equal legs down and 3 legs. So we hold 105s, we turn over down to 90 and 86. Okay, then we've got a little bit of a downtrend in this last C leg, I would call it, down into that area to watch for. But if we fail to break really below this old range low, I think we're kind of in sideways price action here at highs and potentially formulating some kind of triangle or wedge-like structure that can go either way. And I would favor to the upside because of how much we've come and moved through those markets. Now, let's move into row crops real quick. Still watching a very, very interesting for the last couple weeks here that we've been tracking, the spread market for beans versus the outrights. And boy, they're just going in the opposite direction here for the last couple weeks. And that is very strange, right? We wouldn't be expecting to see the August-November bean spread here heading up to 120, 130 over with outright beans heading down towards the $13 handle in November and trying to break below 40 here for, and really just 14 bucks too for that August bean. So very strange to see them going in the opposite direction. I don't think that is sustainable. We'll see one, in this case, the spread market building in inverted markets. It's a bullish signal. So spread markets are still signaling a bullish, a bull market here when we're selling off in the outrights. Something's going to give here. And I think we're getting closer to that bottom for the row crops, and soybean spreads might be starting to signal that a little bit here. All right, so moving into just outright soybeans, let's take a look real quick at the daily chart here where some of those big technicals are. 18-day moving average has now started to slope lower, broken below that 55-day and 100-day moving averages here in the last couple days of trade. 55 and 100-day moving averages up are at 140, 1498 and 1483 and starting to roll over. So look out for that bearish crossover of the 55-day over the 100-day here. It's probably pretty much bound or guaranteed to happen unless we somehow go limit up, and just, really rocket higher. We'd have to get all the way up, back up to 1450 and above for us to, I think, unwind that. But we do have open gaps in this chart. The first one's up here at 1536 area, and the other one here at 1395. Kind of interesting. We've basically pulled back into the old highs. We've unwound all of 2022's rallying gains and unwound back to the last year's end of marketing year highs. Harvest time frame highs, I should say. So from March through December of last year, for a 6-month period, really, I guess you have to call it the March top, but it was really June 10th. That 6-month period, soybeans, the old crop, well, it was new crop at that time, but 22 soybeans had not broken out yet, and we're consolidating sideways in this range. We've come back down now to test the high end of that range. The 200-day moving average, we gapped down to and below on that gap open this weekend, so pretty nasty price action. The trader in me says we've come too far too fast, but this little kind of doji-like slightly positive day here is not enough for me to consider a reversal. And while we are oversold here in the daily RSI, and we are, in my opinion, very closer to a bottom than we've probably ever been, I think it's very hard to call this a bottom just yet. And in fact, it's almost irresponsible to. Last week's quarterly grain stock and Planet, whatever the heck they gave us, an acreage report, resulted in a new spike rally up into the $15 handle. That was a 50% short from the 1584 highs down to the lows at the time. That has gone to and through its target now, downside target of 1350, and we've even approached the 1285 secondary target. So now that we've gone to a target, we can actually take that 50% swing off of our charts. The next in the series now would be a 50% pull from the 1507.96 highs down to the down to lows of 1302, half that we made. That would give us a 50% pullback towards 1405 to look out for, and that would also fill our open gap. So look for resistance up into the $14 handle if we get back up there as the next in the series short. If we go above 1436, now we're talking about breaking the series of shorts off the highs for the November beans, and that would actually open the door for the potential of a move back towards, a contract high, or we could at least start talking about that type of reversal. But again, that's $1.36 higher from where we are and $1.12 from where we closed the day. Kind of a long shot to talk about. We also need to watch the 13.99 anchor to lows swing short here. Extended short 1351 is the resistance there. If we break down the 15-minute time frame now, we can also see a similar level just from the gap and the highs of the day down to lows, swing lows here. The 50% short actually already traded up into the 1340 area, got a reaction. I would not be surprised to see us though push up to 1350 before rolling over, but technically speaking, this market does have a downside target of 1288 at this time. And again, if we break down how low can it go, and having come down to test the idea of beans in the teens, I would not be shocked to see soybeans take a run below the $13 handle just because we're here. I know people probably don't want to hear that, but that would cause to me some capitulation through a psychological level that I don't know, if I was a commercial buyer and I spent the first half of this year twiddling my thumbs not knowing what to do with these high prices, I'd probably be trying to buy up everything I could, given the last 3 days we've shaved off $2 off of this market. And that is just, in my opinion, too far too fast. But this price action, how we closed out today, doesn't look like a bottom to me just yet. And there's definitely some levels to look for us to break to the upside. Certainly 1365 in the very near term would constitute us probably going back to fill the gap and trading up towards that 1408 area. And again, that would give us a good reversal to talk about for potentially reversing the price action we've seen. December corn, trading at 585 into the end of the day here, right down into the full 50% swing for the contract. You can see here below the 200-day moving average at 615 here. We actually have a bearish crossover as well below that 100-day moving average now, and watch out for that 55-day coming down towards that 100-day. 713 on the 55-day, 684 on the 100-day, 674 on that 18-day moving average, and 615 for the 200-day. So for both corn and soybeans, getting back to that 200-day moving average to test it here in the next couple of days is probably the short covering rally, or to some capacity what we'll see the market do. But we have to admit that we have some open gaps on these charts that we have not closed in the last couple of weeks to the downside that we need to be aware of. Corn actually came down and closed an old gap here. We talked about this 570. It was really 567 area all the way over here on this chart. You can see the little gap right here. Boop. back on the Sunday open in early February. We left that open for 4 months now, and we finally came back down to fill it, and it also filled in at that 50% level. So, corn with weather markets coming up here in the very near term, right? We're 2 weeks out from pollination, most places, maybe three. Weather markets aren't even here yet. The true weather markets. Yes, I think we're remaining with some weight on the shoulders because of what we've seen from, okay, we got some rain. The temperature forecasts are for normal with, normal to slightly below normal precipitation forecast, but those don't mean anything to us until next week actually gets here. On the way down, though, we did definitely leave some open gaps here. 730 was one of them. Another one, he's like kind of here at 674, 673 area. And then finally, we left that open, we left a gap open here on this week's open. So 606, 673, and 730 open gaps above. We came down to fill this old open gap, traded 50% for the corn. Going out to the daily time frame here, there was maybe an old trend line resistance that we gap below. Certainly could become a new trend line, or trend line support, I should say, but might be resistance on the way up. Either way, like the soybeans, the corn kind of came down here to test, again, old breakout levels between the 530 to 560 area that we were holding into the end of last year, and basically began the run up here from last year. So we unwound 2022 price action. We certainly caused as much pain to the longs as we could. The bears left open gaps on the way down, which is all just fuel for a reason we could see some short covering and a reversal higher. Now, does that mean that December corn and November beans have the capacity to get to new contract highs? Maybe, but I think it's going to probably take through the new year to get all the way back up there. However, in the meantime, there's going to be a lot of resistance to chew through on the way back up, but we have a market that's pulled back so far. We have a clear reason for it to potentially rally here, in my opinion, once that short covering begins. Certainly oversold in the daily RSI and all that good stuff. So let's look at the short-term levels for corn that, if we start to reverse, we can continue to watch. It actually has been somewhat of a technical move to the downside. Some of the moves were rather quick. As of right now, I believe we have an extended short here that, again, if we get up to fill this open gap, breaks this lows to lows extension short. And then we're also, from the gap high to lows here, you can see we already traded a 50% level. We've come back up to test that here at 586 in today's close. So above 591 probably opens the door to obviously $6 resistance and defending that gap fill. We get a gap fill, go to 609. That's when I would start drawing up 50%, ambush longs for the reversal, because at least corn has traded into big technical levels that we identified last week. Talked about, hey, if we get down there, that's an interesting level we want to see a reaction from. Well, we're seeing a reaction from. Now, if it breaks the series of shorts or the reasons that we would be sellers on the way down, then we can start putting in, reasons to be a buyer. So corn getting close here, and both corn and beans could have a reason to reverse, but just not there totally yet. Wheat, not much to say about the wheat. We are just September wheat in particular, the full 50% for the contract. I think wheat, you kind of have to step out to a continuous chart here and take a look at what it's been doing, because from the 385 lows to the highs after, 870 was a 50% pullback. We've come down to retest the old, the lows right before, and the range, I should say, right before this Ukrainian-Russian crisis began, sent wheat sky high, and now wheat's corrected in 1, 2, 3 waves lower. The old 50% here got initial reaction at 1040. We then broke, but you got to consider the idea that we might have a top in for wheat for a bit, and a pretty aggressively sold downtrend here. That's resulted in extension short here from the last one I was tracking was from 1026 down to $9, 963-ish down to the lows. So now from lows to lows, resistance here, look for it up into the 841 area. We go back above, though, 860, we might be starting to talk about somewhat of a reversal higher. But at this time, I really only am drawing up the shorts on the wheat until until the market proves itself to me, because it led its way to the downside. It's kind of a weird time of the year. So we'll see what happens. Feeders and the live cattle seem to be very range bound still bouncing between those two 50% lines here at 174.95 and 169.83. We're right in the middle of the range. You can make a case for both 50% longs, 169 low to the high here holding, 50% short off the highs also holding. So pretty technical range market that if we go above 177 or below 170, I think we're going to get, the market will probably push in that direction. And then August fats, very similar. In essence, we're caught between a broken 61.8 line at 137 and then a broken 61.8 line down here at 133. And we're chopping around, also wedging, forming some kind of sideways price action. So cattle going nowhere quickly, a weird time of the year for it to have a lack of a trend. Actually, by now, we've usually topped out in cattle. They're holding support. Something's in there holding cattle up. I mean, strong, obviously, pretty strong cash markets as of late, and being at a discount to the cash is probably a good reason why the futures are doing this. But seasonally, I think there's also that seasonal selling pressure that's keeping it capped and fear that the market might turn over. Well, that wraps today's Strategy of the Day update, everybody. Please do join me tomorrow at 2 p.m. Central. We'll cover these ideas in more detail, go over maybe some option strategies that are starting to make sense here. We are starting to look to position here in row crops, and we'll go over those tomorrow. Oh gosh, what else was I gonna tell us here today? Nothing, I guess. 312-277-0110. Find me on Twitter and Facebook. Shoot me an email, dhussey@zaner.com. Oh yeah, the link will be down in the comment section or over in the information section to sign up for that webinar. I will be going to a closed webinar for that Thursday session, but I will be bringing you more of these Strategy of the Day updates here to share my ideas and keep the conversation going on social media. Have a great day, everybody, and we'll be back with you as price action develops. Take care, everyone.